you're a home buyer, somebody or a young person looking to buy a home, you need a bit of a reset.
There is a possibility on the other side of this that inflation could actually be quite low.
Welcome back to Real Estate Mindset. Today's video is going to be absolutely bonkers. And today I have a fellow great financial crisis survivor, Melody Wright. Melody, thank you for joining us today. How are you?
I'm doing well, and thank you so much for having me. It's a pleasure to be here.
It's nice to have you. And guys, real quick, let me kind of explain, and I'll let you take it over here in a second, Melody, but let me explain Melody real quick. First of all, before I do, you guys, go to her channel, Melody Wright on YouTube. She has some amazing intel, amazing videos on the housing market. And what I like about your videos and about your intel, especially, Melody, and why I'm so excited is you're kind of, to me anyways, you're the other side of the coin in that you deal with the secondary market, what's going on behind the scenes. Whereas my profession, over 20 years of profession, is dealing in the front end of real estate, dealing with consumers, origination, looking at consumers in the eye, right, helping them. But what you do is basically, after the close, after, the consumer takes pictures with the key, they drink their champagne, they get hungover the first night, they wake up and they're like, oh crap, here's reality. So Melody, can you tell us, I think I explained that okay. Can you tell us what your profession is?
Sure. So, I kind of started off in mortgage finance, which was really looking at both the origination and servicing side. Origination is what you work with the most, Travis. But even that, like you said, at the closing table, you get up and you walk away. We pretty much take it from the closing table. And from there, essentially what that lender is trying to do, most lenders, 95% of lending out there, they're going to go and sell your loan before the ink is even dry to the secondary market. And so basically, we call it deliver or ship to one of the government agencies, be it the GSEs, Fannie, Freddie, or FHA, VA. And so ultimately, you have all these lenders all across the country that kind of get your loan after that closing table and say, hey, Fannie, Freddie, FHA, Ginny, who wants to buy my loan? What points are you going to give me on my loan? And everybody's going to look at the pricing and they're going to say, okay, I want to sell it. And, and you can sell, like there's multiple ways this transaction can actually work. Like you can sell it completely, retain nothing. And a lot of people do that. They don't want anything on their books. Or you can sell it and retain what we call servicing. And that's the right to service that loan. And you get a tiny little fee to do that. But a lot of people in this business want to, because it should act as a natural hedge. So when origination is down, your servicing assets should go up. Because people aren't paying off fast. So it's a whole bunch of confusing stuff. You'll tell me in a minute how much detail you want. But generally speaking, this is what happens. And so people say, okay, I want that pricing. I book it. I get my gain on sale, which is that instant sort of like juice to the income statement. And they may retain the right to service, or they may retain a mortgage-backed security, but most of your smaller independent mortgage banks don't hold those mortgage-backed securities. Those are really the playthings of our bigger banks, of the Fed, and they use those assets to pledge as collateral for other borrowings. So it's a very complicated machine that most people don't understand. So what Fannie Freddie does is they will package up those loans, they'll securitize them, sell them out. And so for anybody that's watched The Big Short, they kind of explain this, except if you think about it was the tower of like the good stuff and the bad stuff. It's generally all the same stuff these days, but there is still some risk involved. So you sell it to the agencies and then they create the security and sell that security to investors. So I'll stop there.
Thank you. No, I'm so intrigued because honestly, if you really want to understand what's going on, you got to look at the nuts and bolts. Everything else is a little bit of assumption, a little bit of, historical data, but you
Right.
got to see how it's running. You got to see the performance of these mortgage-backed securities, these loans, the defaults, the forbearances. So I want to tell our viewers, basically, what Melody and I are going to try to discuss today is we're going to start by talking about forbearances and foreclosures, that whole foreclosure process. And then hopefully I can transition to mortgage-backed securities that are held by and serviced by the top three lenders. I remember, when I was in origination, I generally locked with Wells Fargo. So I know, for example, Wells Fargo has a ton of my loans at 2 and 3% because I was refinancing my past customers into 2 and 3%. So we'll go into MBS, and then we're going to eventually get to new home inventory, new home data. Between Melody and I think that we got a good grasp on what's happening with new construction. And then as long as we have time left over, we're going to go into the STRs, short-term rentals, Airbnbs, the bans, the stock sellings, the bad financing, the fact that investors, Melody, they just can't stop buying. I'm talking they can't. It's like, I have to keep buying. It's
It's like an illness. It's weird. It's like an addiction to crack is what it's like. I mean, they're addicted.
Those Airbnb owners are, it's like addicted to crack because they're now using like 9-10% loans now to buy Airbnb. Yeah. And I talked to a Melody, and the first question I have as soon as I found out someone just bought an Airbnb is, does it cash flow long-term rental? Right? They're like, no, it only cash flows Airbnb. So they're really at the mercy of an industry that is under attack from all sides.
And oversaturated exponentially, right? Completely oversaturated. So yeah, we can get into that for sure.
So I want to start here, Melody, at the delinquency rate at various loans. Obviously, we know, you and I know, FHA, a lot looser guidelines, depending on compensating factors. Loan officers and underwriters can go up to 56.99 debt to income ratio based on gross income. So that may be why, can you explain why we're seeing the, delinquencies in FHA compared to conventional? And then Melody, will you explain the current foreclosure process right now? Like when someone is 30 days late, what happens to their credit, and things like that?
Yeah, absolutely. So, I think what a lot of people don't realize is that, the mortgage market has become a government market, 95%, and only 5% is sort of geared toward a private marketplace. Now, I think that there have become shadow lending that started to happen that a lot of us don't know about. We'll talk about that later. But ultimately with the FHA, it's doubled. That lending has doubled since 2009. And they've basically taken the place of a lot of the subprime that was originated during the crisis. And so people look at it as a government product, and they don't necessarily care about the credit scores or care about the performance because they believe that it's backed by the government, and so they're going to be made whole if they kind of buy these servicing rights, et cetera. But the thing with FHA is you can go down to a 580 credit score with a 10% down payment. You can go down to a 620 credit score with a 5% down payment. And unfortunately, what's happened, Travis, as you well know, is that people stop looking at the ability to repay. They just looked at credit scores. And then they also looked at, I would say haircutted obligations, meaning, student loans. You weren't looking at the full balance of student loans. You were looking at that monthly payment when people were originating. And due to an Obama program, their affordable program, that payment was like $250 a month, where in reality, those borrowers should have been paying $1,000 a month. And so people just kind of like, I think there's been some great articles in both the Wall Street Journal and Bloomberg on the inflation of credit scores, meaning that these credit scores do not represent the same health of the borrower that they did back during the GFC because of these things like, student loan debt not being reported. The fact that, mortgages on forbearance weren't being reported as delinquent. They were being reported as a forbearance. But, if you understand credit scoring, it's almost like everybody just got a pass, got an extra 100 points on their credit score while people weren't looking at debt to income. And so these FHA borrowers are not in a great position to begin with. They, and then the minute something happens, they don't have huge savings. If something happens, they need to call a plumber, their car breaks down, et cetera, that just starts to it carries weight that doesn't, and these other very high prime borrowers, they can go do things that maybe they can sell an asset. Maybe they can tap their savings account, but FHA, typically, if you're using the FHA program legally, it should be first-time home buyers. And we understand that this program has gone off the rails. It's not being used like that. In many cases, there's a lot of non-owner occupancy fraud. It's being used for a short-term rental. But it's taken a huge share of the market. And so, in my opinion, most of these borrowers were already getting into delinquency and trouble in 2018 and 2019, and they really did not have the ability to repay. And then COVID came along, helped them hobble along for some time. And then they took out solutions like the partial claim, which allowed them to take all those forborne payments, 18 months, and put it at the back of the loan. So point is that these are risky borrowers. It's government subprime. There's no, credit scores of 580 and 620 is not what most people think is being originated out there. They think it's all, because the industry does a lot of what I call credit quality gospel singing. Everybody's like, we are so disciplined. We don't take risky borrowers.
You know what's really crazy, Melody, is, and I hate to say this to you, I know you're already stressed about like what's happening, but I could actually go down to 580 FICO score with 3.5% down. As long as I have obviously the AUS approval, automated underwriting service, LPDU, and generally
That's
you could
it
do
right
that.
there, Travis. Yep. Mm-hmm.
And normally you could do that, Melody, if they just had 2 months of reserves. It literally took as long as you have $5,000, $6,000 left over when you're closed, here you go, 56% DTI is fine. They're overextended. Almost everyone that I have helped, despite what I say, because I'm preaching to these people, is overextended. And I try to explain if anything happens, and I'm not even talking about repairs, like we know that, but what happens if you lose your job?
Or your insurance goes up 10%.
Right. Like in Florida.
Yeah.
So these people that purchased in 2020 with the low rates that were probably overextended to begin with, now they have skyrocketing, insurance in Florida. Everyone has skyrocketing property taxes. The consumer is under, attack. Can you, Melody, talk about COVID forbearance ending this month and potentially what impacts that may have on the market?
Absolutely. So this COVID forbearance was unprecedented, so just quick history, during the GFC or after the GFC, I helped manage default. And so, but this is 2012, 2013. By that point, all the subprime was gone. This was your traditional, prime borrowers. And so very familiar with the term loss mitigation and how that works for mortgage. Well, back then you had your GSE or Fannie Freddie, FHA, and then FHA VA programs that, essentially a lot of people got mad at the banks because they thought the banks were saying no. In reality, it was these government programs saying you're not eligible for this modification because all of the privates would mirror what the GSEs were doing. So this is a very complicated topic that I kind of want people to understand. But then came along and you would have to kind of re-underwrite the borrower. And that's why so many people did not qualify for HAMP, Home Affordable Modification Program. And there's some great articles out there. Everybody thinks it saved the day. It did not save the day. Wall Street investors came in and bought up homes. That's what got us through the crisis.
Melody,
and so
back then, they did people didn't even know what loan modification was. Like I remember when what was it, like World Savings and then Wachovia and then like Bear Stearns and then now it's like Chase. I remember my buddy was in the loan modification department at Chase and he was like, Travis, we don't know what the hell we're doing. And no one qualified. No
one was qualifying. Chase, just like us at GMAC, we were under the consent order. And the Fed said you have to reevaluate that borrower every single time they ask, regardless if nothing has changed and regardless.
What?
Right. So it would put the foreclosure on hold. So essentially, you'd review the borrower, but if they called in again and said, I want a loan mod, and a lot of people started to figure the game out, you would stop the foreclosure. You'd have to review them again. And this would just go on and on into eternity, even though the borrower couldn't qualify, more stressful for the borrower. And then finally, the Fed, kind of said, okay, we're going to step back and let the CFPB come in. And then we only had to review the borrower once. They could do a dispute and you'd review them again. But I can tell you, we reviewed some borrowers hundreds of times. So it was pure madness back then. And you're right. No one knew what a modification was. My CEO at the time stood on a table screaming at the Fed, a modification is not a right. And, he was accurate. We broke contract law. And so I'm all for helping borrowers. Do not get me wrong. If we really wanted to help the borrowers, we should have stopped with all the rigmarole, all that money that was spent on those special reviews, all that money that was spent on the civil money penalties. All of that should have gone back to the borrowers if we really wanted to help. But anyway, that's that. So, but you essentially would have to re-underwrite the borrower. They had to qualify. Well, COVID comes along and they do this COVID forbearance, and you don't even have to call in. You don't have to tell anybody anything. So you would have to get what we call right party contact, making sure that you talk to the borrower to get their hardship reason. But what happened during COVID is you got put on a forbearance, even if you weren't even calling in or talking to anyone, even if it wasn't COVID related. And it just kept getting extended. Like most forbearances were usually like 3 months, 6 months, whatever. So this extended 18 months. Okay. And then from there, you would have different types of workouts. If it was and by the way, if you still haven't called, what they made the servicers do is they'd send you a modification in the mail without any of your updated financials, any of your updated information, and they would just make an assumption that nothing had changed. And that was unheard of back in the GFC. So you do nothing, you've never called in, you open up your mail and you say, hey, your loan is going down by $200 a month if you sign these papers. You've done absolutely nothing. And nobody knows how good your finances are. So then if they don't accept that, then you have this big delay in time and you have to work with them and you have to call and keep trying to get in touch with them. And so the biggest solution, 18% of the 8.5 million people who took the forbearance did what we call a payment deferral, which is, and this is completely unheard of in mortgage land. You took those 18 months of payments, you put them at the back of the loan in a non-interest bearing lien. It just sits back there until you pay off that loan or you sell your house. And by the way, no one knows about this UPB. So no one talks about the combined loan to value. Okay, now the servicers know, but nobody's really talking about. So when everybody talks out there, like, oh, all this equity, they're not talking about this combined loan to value. So we've withdrawn equity in a way that was very similar to the crisis, except not, if you know what I mean. Like it wasn't the borrower taking out a second lien like they did back in, 4, 5, 6, or closed in second. We've essentially, the government gave them that second lien.
That's crazy,
but
Melody.
Nobody's talking about it. Nobody.
That's crazy too, because I never even considered, like, basically, just to recap what you said, you guys, through this COVID, we're not talking about normal mods. By the way, COVID forbearance is ending this month, but through the COVID, so they would take all the money that they owed, they would make what's probably called a silent second with no interest bearing. And we got probably millions of households around America that have a silent second mortgage that you're only going to find out about from running a title report.
That's right.
So
it's not going to come on the title, Travis.
Why?
It's not recorded. So
what?
And that's correct. So in the early days, this is how crazy this is. And you're the only person that I've talked to so far that kind of gets it. So what's so crazy is when this first started, they said, you're going to have to record those payment deferrals. And I was like, absolutely. Of course we are. Like, of course. And so I started prepping docs. Then they came along, they said, no, you don't have to record them. So you will not find it on title. You will not find it on title. So you have no idea. Yeah.
Why?
It's crazy.
Why
I think that's a good question, Travis, but I think that everybody just wants to keep the game going, and they want, through the election, they want the consumer to feel richer than they are because it's not on title. And then, so 18% of these 8.5 million, if you think, I think the median payment back in 20, when a lot of these started, was around $1,600. Do the simple math. This is not an insignificant chunk of change. I'd say on average, I'd say a year and a half ago, there was a study done that said it was about $8,000 per borrower, okay, that took out a forbearance. Not all of them took this. So that's kind of smoothing it all out. But in reality, I would say it's probably more likely between $25,000 to $90,000 per borrower that took it. So if you just do the math of the 8.5, that's 1.5 million people that probably have a silent second around $50,000 to $75,000.
Unbelievable. That's unbelievable to me.
Right. No one talks about it.
Melody, how are we supposed to understand? That's what I'm saying. I'm so glad you're here, because how are we supposed to understand what's going on when we can't even access the data? Like a silent second, it just doesn't make sense to me. Can you, Melody? You get me all spicy right now, girl. I'm just trying to calm down. Can you tell me a couple things like, what impacts do you think? Okay, so the COVID forbearance extensions end this month, November 30th, or 30th, I believe, 31st. Can you tell us what impacts you believe that's going to start having on the forbearance, department and the foreclosure department? Because right now, people in forbearance under foreclosure, that's not harming their credit. Is that correct?
Well, in the forbearance, in the foreclosure, it is, but but honestly, the forbearance, so that all the credit reporting goes back to normal, and it's honestly those last 300,000. I'm not even. What I'm worried about are the people that have used all their benefits, and that's what you're seeing now. Like when I look at my client books and I look at who is driving this tick up in 30, 60, 90-day delinquency, it's either the people that really should have never gotten a loan in the first place, the people you were just talking about that can't pay for a repair, are already overextended, have no savings, or it's the fraudsters that, said it was owner occupied. It clearly wasn't. Suddenly they got an escrow notice that's doubling their payment in California. And they're like, what? And they're walking away, without any contact. And then it's just the people that have lost their jobs, like typical default, But my biggest concern are the people that have used up all their benefits, especially in that FHA population. And I think you probably saw this past week with VA. They also get bundled in Ginnie Mae. And sorry, I might brag for 2 seconds, but I saw these stories coming about the VA partial claim, and I wrote in my Substack, like they're gonna put VA foreclosures on hold. And
they did.
And sure enough, just to let you know, something like this would have taken months back during the GOC. We are on steroids due to the election. And I honestly think FHA will go on hold as well. I think they're going to I think that they'll claim servicing errors kind of like they did before. This is I call it the 2011 playbook, because that's exactly what they did. And so I think we're headed there again. But so in many ways, I'm not looking at traditional mortgage for the fire. I'm not. I think that what's going to happen is this 30, 60, 90 is going to continue ticking up, especially you've got taxes due in California this month and next month. Florida just got their escrow notices. People are going to start, freaking out. Delinquency is going to keep going up, but likely your state AGs and others are going to get involved at a federal level. We've already seen it happen. They'll put these on hold through the election. And so Absolutely. I mean, absolutely. And if federal doesn't, state AG will, because, they may be up for a reelection as well. So or appointment. I mean, so, this is going to happen. And it's just a matter of time. So, but where I'm more concerned about distressed selling are actually in these where they didn't take out a traditional mortgage. They either use something like a hard money loan or these private note sales that each day I hear more and more about, but no one's tracking. No one has any. And these are just smaller investors. I've talked to a couple this week that would find out people that are in distress, and then they would go and offer them money, and then they bring their loan current, and then they do a closing, and no one's tracking this market. No one.
Oh my God, Melody. I just did a video, and we'll come back. I just did a video on this. It's like a cult of people that are doing sub 2. And I'm trying to explain to people,
they just use it like that's some kind of word. I'm like, what do you sub 2, subject to? Yeah. And they don't understand the law, Travis. I just talked to one and I was like, oh no. So yeah.
I'm telling everyone, Melody, I'm like, yeah, I understand. They're like, Travis, you don't understand it. I'm like, yeah, I do. You hide what you just did from the existing lender. They're like, well, when you go to a grocery store, you use a credit card to buy something. It's not your money. Well, and I'm like, well, you got qualified for the credit card.
It's in your name, buddy. And that's the thing about what people don't understand about this process. They think you can record a deed. No, we go by the Uniform Commercial Code in this country. It's about possession of the note. And so what a lot of them are doing is they think they could turn it fast enough. And so they're giving out money and all kinds of stuff without that possession of the note. And if they don't find the funds, they're going to lose everything they put in, because that lender every day and night is going to beat you in court because they have possession of the note. No deed is going to save your butt. Deeds aren't legal. I mean, that you record something at the county. That's not how you claim ownership. And this is what people just don't understand about the law, about default law. And so all these people have gotten involved. And because the market was turning so fast, they were okay. They were okay for a little bit of time.
Right.
But now sales are down. Now people can't, so the music's stopping. And a lot of these guys are going to get caught so red-handed. And I don't want anyone to get hurt, but at the same time, I'm kind of at a loss. How do you even regulate an industry like this?
It's already regulated. It's already in a contract. There's contract law. They're disregarding, saying they're never going to collect. They just want to make money. And I'm just like, you guys are paying on 2% and 3% loans. They want to get rid of that crap. They want you to have a 7% and 8%. So if they find out you're doing a sub 2 and you took over someone's house and their payment, there's only a matter of time. I think it's a ticking time. Like, who wants to invest in real estate knowing that the lender can call your loan any day? And everyone's like, you just don't get it, Travis. You just don't get it. I'm like, it's simple. Like, a child could understand you're hiding this from lenders that are insolvent, lenders that are in distress.
Yeah.
I don't think it's going to end well.
No, it's not. Yeah, go ahead.
We could talk. I mean, there's just so much good
stuff. I know. I'm sorry.
No, I love it. Can you talk about, so first of all, I love how you explained that silent seconds aren't even being recorded. Basically, with the COVID forbearance plan, it was a gift. And the fact that it's still, the extensions are still here is wild. That ends this month. That's great. We're going to be back into a more normal forbearance where the credit's going to be destroyed. There's not going to be so many extensions. Can you talk, Melody, because I have a lot of viewers, they always want to know about down payment assistance programs, specifically grants that they're forgiven, not bonds, but grants. But I try to explain to people, like, y'all, if you don't have even a down payment for a house, how would you repair an AC? How would you, any repairs for that matter? Down payment assistance programs, Melody, I've been told, you will know more than me, have the highest rate of foreclosure.
I'm sure.
Is that correct?
I'd have to validate, but I would think so. I mean, if you can't afford that down payment, and listen, guys, I want everyone in this country to have a home. I would, my dream is that everyone has a home. But at the end of the day, getting into a home that you can't afford wrecks families. It wrecks marriages. It wrecks children's lives
Yes.
because you are fighting nonstop
Mm-hmm.
because you don't have the money for the bills. You also feel insecure. You're always worried you're going to lose that house. The amount of stress that it causes, and so getting into a home, and this is something I've actually studied. And I used to, before I got on YouTube, I used to do in-house training, but you can go back and historically look at a home ownership for primary residence in our country. And you can go back and look at how the government got involved in the 30s, and they got involved again and again and again, and they always tried to push it up. But every time you try to push it over that 64, 65% home ownership rate, like things just go south in a hurry. And I can't tell you why that is. I can just tell you that, there's a lot of reasons people can't afford to buy a home.
Right. Honestly, I've thought of that, Melody. I'm pretty sure I could tell you right now.
Yeah,
it's
tell me.
because, first of all, home buying demand has always been on the side. Every single person in America wants to purchase a home, but not every single person yet, maybe next week it will be different, is responsible enough to afford home ownership. So what happens when they remove regulations that are designed to protect consumers, when they remove those regulations, everyone gets off the sideline. They go in purchasing a home, not knowing anything about the impacts of affordability, property taxes, homeowners insurance. They're told, Melody, by their realtors, just buy now. You can refinance later.
Date the rate. Date the rate.
Yeah, I hate it.
That phrase makes me want to just lose it.
I hate it. Because I'm like, you guys, you have to qualify. You can't just, and what if you have no equity?
Right.
What if you have no job? And not only that, Melody, like the amortization schedules, I'm like, you guys, first 5 years of a normal house, you're paying $125,000 in interest only. You refinance, you do it again.
People don't understand because we have abysmal financial education in this country. That's another passion of mine. But people don't understand this. Like everyone should have to learn what an amortization schedule is. Every single person should have to learn that before, if you're going to take out a student loan, if you're going to take out a mortgage, you should have to go to a class and learn how it works before you can even sign those papers, because most people have no idea what they're signing. They just, I feel like it's the Big Short quote, right? They just want a home. Well, yeah, they do, but they don't realize that they're, you know what mortgage means, right? Do you know what it means?
Me?
Death pledge. Yeah, it means death pledge. That's literally what the name means, death pledge.
That's crazy.
So, and I see these 40-year mods like as part of workouts for these people that got the COVID forbearance. And my heart just breaks. Can you imagine? And they still can't afford it. They still can't afford the 40-year mod.
Well, Melody, like the thing is, I don't have to imagine, in 2009, dude, everything you just said is exactly what happened to me. When I lost my house, I gave up. My family, suffered. I lost the relationship. My child, who lives with his mom now, he suffered. But like, I can't, I try to explain to the viewers the psychological impact for me and the depression that I had to go through. Like I felt like a total failure. And then like when you have bad credit and you're struggling, it's even harder because everyone says no to you.
You're a second-class citizen. You're not, you're treated like dirt,
Trash.
Yeah.
So what is this? And we'll move on to the MBS, but before we do, and I have my own answer here, but what do you think is the solution to the foreclosure crisis, the forbearance crisis? What is the solution here?
Well, what's going to happen versus what's the solution?
I know, right.
Honestly, what's going to happen is something similar to what's going on with the VA loans. And that is the distress loans are going to be bought from, the servicers. They're going to be put on the banks, on the balance sheet of the agencies, and so I think what's going to happen is that all of the agencies, Fannie, Freddie, FHA, VA, are going to get in the business of holding these assets because they started back during the crisis with real estate owned. You may remember that, the servicers used to handle all that. The agencies realized how much money they could make at auction.
Mhm.
So they took all that away from the servicers. They do all that asset management themselves. They hire third parties, don't get me wrong. But I think similarly, they'll probably take all those distressed assets onto their books and then, try to modify them in some way. That's kind of what I see happening. But honestly, Travis, the solution is to let the process play out. And I know that's not what people want to hear, but I can tell you that the people that I had to deal with when I managed default and the letters that I would have to read and the things that they would say, they were no better off, in terms of staying in their home for an extra year or even 2 years. The amount of stress of never knowing if you were housing secure was just so overwhelming. And so to me, if we're going to give out money for free, I would probably give them some kind of relocation assistance, like we did at the end of the last crisis, cash for keys, right? Like just let everything go through, but let's just do grants for cash for keys and relocation, and just give people, like if you were going to give them free money anyway, just give them some money to transition from this hardship. That's to me what I think would be a better solution than letting them suffer. Being afraid to answer the phone, Travis, half the time we can't even get in touch with these borrowers. Like I can't tell you, I do something called subservicing oversight, where for my clients, I look at the way that my clients' borrowers are being treated. And you can just see over and over, borrowers aren't picking up the phone. They're mortified. They don't want to admit what's happening. And so to give them a real solution, I think would be a lot better than just putting this crap on. Or honestly, in the case of VA, this is 6,000 loans we're talking about. Hire me to do a loan level review. I'll have it done in 2 weeks. And I'll tell you who got screwed and who didn't. And I'll tell you which servicers you need to go find, which they could do that in 2 weeks. It would be that simple. But no, they're going to pause the entire process, not understanding the downstream implications until the election.
That answer just goes to show like how different we are. Like that's the total like secondary market answer. Like my answer is like the front end, and I would have been like, don't buy an overvalued house.
Sure. Sorry.
No, because I'm always thinking like, consumer. I mean, the solution would be no fear of missing out. The solution would be accountable realtor, right? Like that front end.
Yeah. On the upfront, for sure. Yeah.
Upfront, right.
Sorry.
But on the back end, which is your expertise, dude, you gotta let it play out. Like you're just enabling the bad behavior.
Take that $5 billion that's still left in down payment assistance and give it for relocation assistance.
Transition.
Yeah. Sorry to interrupt, but yeah.
No, you're good. No, that's so brilliant. I never even considered that. So let's move on. Okay. And before we get into home inventory and just touch on this, as much as you feel comfortable with, let's talk about mortgage-backed securities, or rather the new subprime, if you will. Yeah. Who would have thought that prime 2% and 3% mortgages is the new subprime? So this is what I wanted to kind of run by you. I've heard reports, I need to confirm, but that mortgage-backed securities, so the packaged loans at the low interest rates, like under 5% interest rates, about 40% of the total assets held by the top three banks, Bank of America, Wells Fargo, and Chase, they have those non-performing mortgage-backed securities. To me, that makes them a bit insolvent. I mean, where are they going to get the money if people want their money, if there's a bank run? Can you talk about the MBS market, Melody, and how that would impact the big three?
Yeah, so I think a lot of people, I've seen some of the same reports, and I kind of try to do a deep dive into mortgage-backed securities because I think folks got it wrong. They wanted to talk about the shock value that there's a securitization out there with credit scores around 600. Well, anybody that's buying and selling, they know that. They 100% know that. What they're banking on is, number one, the MBS is going to get paid. Fannie and Freddie are going to advance those funds no matter what. Period. Like that's that, unless they become insolvent and they cannot advance the funds. And so the way that it works is, so basically the servicer takes everybody's payments, and they put it in a bank account. Fannie and Freddie go ahead and they send that money to the trust, to the investors in the mortgage-backed security, and they turn around back to the servicer and say, "Hey, servicer, give me all those payments." And the servicer says, "Okay, I got the payments." And they pay Fannie Freddie back. Well, if you don't get all the payments, you still have to pay Fannie Freddie back. But the investors always get paid. They always get paid. And investors also know what they bought. They know they've got a 600, credit score securitization if it's Ginnie Mae. And they are actually provisioning for that. Even if they hold it for investment, they have to provision losses on that based on performance. And they have very complicated risk models. Now, the banks are in trouble for a whole bunch of other reasons. And so, and will MBS, the banks are in trouble from their unrealized loss perspective. And there's a lot of great deep dives on this. But to me, where the banks are going to have trouble is their collateral is not, they're going to have collateral shortages, meaning what banks do all day long is they say, "Hey, I've got this asset. I'm going to pledge it. Can you give me, $100 in cash?" And that's great. And that works all day long in these huge markets, except kind of what happened last week is the DTCC, you don't even want to know who they are, but essentially they kind of said, well, now you're going to have to place more to pledge when you use a mortgage-backed security. And so when I got $100 last week for my mortgage-backed security, this week I'm going to get $50, which means when I turn around to pay another vendor or another counterparty, I had $100 last time to pay them. I got $50. So now I've got to start finding other assets to pledge. And then I may take assets that I was using for something else or that somebody else needed. So suddenly you have markets that just start seizing up, which is very similar to what happened last week with that very unfavorable treasury auction, which, many in the press tried to kind of blame on the hack of ICBC. And that's not what happened. Was that a part of it? But so suddenly, and then the DTCC has come out with more memo. The point being that those mortgage-backed securities are not going to fall apart the way that we think about in The Big Short, not for the next couple of years anyway. What's going to happen is they're worth less, and therefore you can't pledge them, and you are going to have less cash than you actually think that you're going to have. And so think of them as like, it's kind of like a coin that you have that today is going to be less, a lot less when you try to go and get your money for that gold coin or whatever. Hopefully that helps. Okay.
No, yeah, it makes sense. I mean, to me, it's just like, when you have the big three pillars of the U.S. that, for depository banking, and you find out that, well, okay, they have unrealized losses as well. We don't even talk about the treasuries, but there's this whole mortgage-backed security insolvency thing going on. I understand, like FHA, the government insures it, VA guarantees it, but to me, it seems like, again, like a gust of wind, a sharp gust of wind.
Oh, yeah.
Has the potential to knock that over, which would start a potential panic domino effect, which would lead to the unemployment, back to the price cuts. I mean, we're watching everything play out. And I think where personally I got it wrong, Melody, is because I was looking at the unaffordability. Like the viewers on my channel, most viewers on the channel understand how unaffordable things are. And to give it a little bit back to normal, we would need a combination of interest rates going back down to 2s or 3s, wage growth of about 62%, home prices going down 38%. I mean, the unaffordability is at the level of 1980s, but we have the asset bubble that is greater than the 2007 payment to income ratio, 40.5% based on gross income, not counting taxes and insurance. You need to make $160,000. The average person needs to make $160,000 to afford the average home. That's about 13% of households. What can go wrong?
Right. It's a real mess.
So I got it wrong because I started studying the reverse repo market. I started studying, how much excess savings? Oh my gosh, there's still COVID. They are kicking the can down the road right now. So evilly brilliant. It's shocking. I mean, every other day, Melody, I'm finding a new red flag. I'm finding a new reason why it's being propped up.
I'm like a weirdo. Everybody wants to talk about unemployment. And I say, listen, guys, if we just keep going down this path, it doesn't even matter if unemployment gets any higher. It doesn't matter. The amount of unaffordability out there. And, you know, my followers all day long, people I talk to on the road, I mean, people are freaking out and everybody else and looking at their econometric models and saying we have to have U3 or whatever at XYZ. It's like, please just shut up. I just, you know, you're not talking to real people. You're not talking to the people out there. Just today, there's a Bloomberg article that I tweeted out that all of a sudden, you know, these higher end companies are not getting, you know, the top 20% isn't spending anymore the way that they were. Exactly. That's right. They are also being impacted. And so the consumer is not in the health that everybody in mainstream media talks about. So I believe, honestly, if we just keep down, nothing else happens. There's not a credit event, and I'll talk about that in a minute. And there's no uptick in unemployment, which I absolutely believe is going to happen. But let's just say it doesn't. I would say by June is when you're going to see material delinquency. And, you know, by then we'll probably have material for, like, you know, moratoriums on foreclosure. But by June is probably when everybody's going to agree that the consumer's under significant stress. You know, but because we have a few more months for the election, they'll figure out a way to kind of, you know, make people happy, or at least appear to be dealing with the issue. Now, for a credit event, I feel like we are in the thick of it. Like, you know, with what's going on, I saw a chart, Dario, I think is his name, on Twitter, you know, with what was happening with the Japanese yen yesterday. Like, I think we are on the cusp of some type of credit event. The markets, you can just see them struggling in terms of, you know, the big bond markets. I'm not talking about the equity markets. Do not ever pay attention to the equity markets, in my opinion. That's all sentiment. And what you're going to see is it's sentiment and flow. And right now, everybody's thinking about their bonus. They're going to do everything they can to make sure, you know, 2023 ends the year up positive. And that means taking money and putting it in places it never should be in the first place. But these bond markets act very differently. And if we have a true collateral shortage there, we will have a credit event. We've probably already had a couple of bank failures we don't know about because they don't have to tell us. We'll probably see some more of those. But, you know, I wouldn't be surprised if we see even an international bank or an international failure like Country Garden that'll impact our markets here. If that happens, then everything I've said just goes on steroids. People lose their jobs. This becomes, you know, the whole gradually and then suddenly. We're at the suddenly part. And I mean, default is just going to skyrocket. But, you know, so that's kind of, you know, my base case is maybe we get through, you know, the winter to the new year. If we don't have a credit event now, we're likely to have one in March. But, you know, I'd say June, if nothing changes, everything stays exactly the same from this point forward, is when things will start to really show up.
Okay, so let's slide on over to talk about, and I really appreciate your time. We've been talking a while. New home inventory. Inventory is the name of the game. I try to tell my viewers, Melody, that if you guys want to see the price crashing, okay, we're not talking foreclosure. We're talking price. We already saw sales crashing, but price crashing. Look no further than new construction. New construction median sales price is down from October's peak of 2022, 15.7%. And that is them over-reporting value because these new home builders, Melody, are not reporting the incentives like you do with existing home transactions. You have the appraisal. On the appraisal, it says seller's concessions. You remove that from the value. The new home builders are not doing that, even though they're offering 5% 30-year fixed, because they're saying, oh, it's not from us, it's from the lender that's also named Lennar. Okay, fine, whatever. There's so much shady crap going on with new construction. There's so much inventory, so much price cuts. You know, I went to, I'm going to do a trip. I told you I'm going to do a 16-day trip in a few days, and I'm going all over the place to show people all of the inventory, all of the price cuts. Can you talk on the new home inventory and why there's such a lack of data? I had some pizza delivery guy, he calls himself a realtor, do a video about how I'm all wrong because all of the data is reported on the Census Bureau. And I watched this, I'm like, what do you guys want me to watch, some maniac? Like, there's no value. The U.S. Census data is trash. Can you talk in on new construction?
Yeah. And so, just that survey of construction, we know absolutely responses to that have gone down. And also, you're human. When you report, you have a perspective. So anyway, I agree with you. You can look at that information. I believe we should be looking at all the data we can get our hands on, and we have to triangulate to really see what's going on. But, I knew I was just, even though I couldn't prove it in looking at that survey of construction with permits, I could just tell we were overbuilding. And that's when I got on the road in January and February and kind of went out and started visiting these new home sites. And just like you have seen, Travis, I would see these massive new builds that were finished, but nowhere on the MLS. And so what I did is I called people in my industry from the road, people who said they had all of this new inventory on their platform. And I said to them, like, okay, how do you know about this neighborhood? Well, yeah. That was just one off. Then I'd ask, well, what about this subdivision out in, Manor, Texas, who has the highest number of registered sex offenders that, nobody wants to live here. Whole huge subdivision, 10 miles away from a gas station. Oh, yeah. So they would admit, but then I said, and this is where what I realized is the issue. I'm like, okay, so how many of the local private builders are you tracking? Not just the nationals, but local private. I got no answer from, no answer. They avoided the question. I got an answer from another reputable, and it's none. It's none. And so people city planning has gone out the window. There's nobody there. If they are, they're probably taking some kind of bribe or incentive, and nobody's just driving down the street. And what'll happen is if you're one of these investors, they fly you in, they pick you up, they take the highway, they drive you to your neighborhood where you've bought your little built for rent that's hopefully going to give you your passive income so that you can retire early. And they show you how it's right next to a school, the best school district in that city. Look at all this look at this shopping center that's going to be built, except that, they've changed the sign from coming soon 2022. Now it's 24. It's never going to be built. But anyway, the point, so, and then they take them to dinner at a nice restaurant, and then that person gets back on the plane. What they didn't do was drive 2 blocks down the road to see the other new build. And then they didn't take a right to see the other 10 new builds subdivisions. And so you go to somewhere like Round Rock, Texas, and your mind is just like, this can't even be real. And then the people around it think, oh no, those are all sold. Well, why do you think that? Well, it says it on the website. I'm like, well, have you been in there? Because they're not all sold. Oh no, but this is how we don't even, and a lot of times I ask people, just drive down the street. That's all I'm asking you to do. Just drive down the street outside of your daily commute. But a lot of times, like in Phoenix, when you drive down the highway, they have those big walls. You can't really see what's on the other side. And so people just have no concept of how bad this is. And, I know you're going to Denver. And as I did the entire perimeter in Denver, started out from the tech center, and it is one big new build site. I mean, it is just, it's everywhere. And so, it's just kind of, yes, these are not being listed on MLS. If there's a subdivision of 100, they can list 1, or they can maybe list 10, but they do not list all 100. And if it's a built to rent site, it could be a built to rent site of 300 properties. There's going to be 1 card on the MLS. Yeah. And so, we just have, and I did an example down in Century Village, down in Pembroke Pines, Florida, where essentially they have their own proprietary website where they list for sale and list for rent on the Century Village website. And I use that to compare to MLS and Realtor.com for rent. And where there were hundreds listed for sale of existing, there were probably 20 on Realtor.com, which has the most listings of anyone out there. And then for the ones for rent, there was probably 3 or 4 listed on Realtor for rent. There are probably a good 50 listed for rent on that website. So we have no concept of what kind of inventory is out there. And then right across around the corner was a brand new build site for build to rent. So we're clueless. And everybody that's relying on the census, they don't understand too, that during COVID, those county offices where permits are pulled and recorded had delays of sometimes up to 18 months. And so I think that people just have a very muddy picture, and then we can't get real-time, demographic information. So like when I was in Austin in February and everybody's telling me that 300 people were moving there or whatever craziness they were saying at the time, I can't remember, hundreds of people moving there every day. And I'm like, no, are you sure? So what is Austin now? So the USPS just came out with its, survey. They're in the top 5 for net migration out. So as I was standing in Austin talking to people who were telling me hundreds of people were moving there every day, actually they were all leaving. They're now in the top 5 for net migration out. And so you can start to understand this is just about narrative. It's about limited perception and limited data. And you have to go out there and look at the alternative data. And then you have to just kind of look for yourself. Don't believe what everybody's telling you, because, when your paycheck depends on it, that shapes the way the narrative comes out of your mouth. And no matter how good we are as humans, that's just the way it's going to go. And so your realtor may not want to be doing something, that would have negative implications for you, but their paycheck depends on them believing what they're telling you. So sorry, that was a really long answer, but
no, that was a good one, Melody. One of the issues is as well, and and I look at this, I take a step back. I'm like, it's very difficult to ask an agent, a realtor, to be unbiased when now the builders are offering a 5% buyer's commission, and especially with this lawsuit that just happened. I mean, I'm seeing all kinds of stuff on MLS, also on like Facebook, where the bonuses are 10,000, the commission is 5%. And I think that they do that, Melody, so that the agent doesn't negotiate on the buyer's behalf, because the sales reps will be like, okay, we can negotiate. We're just going to take it out of your commission. You see? So I am so disappointed with the profession that I've been working in for over 2 decades. I feel like, I understand people got to still make money, but and I'm not saying everyone is lying. I think you hit the nail on the head when, it's basically a lack of comprehension. It's a lack of understanding. Yeah. But even then, I don't think that's an excuse, because if you're a professional and you're taking the American dream in your hands of home ownership, you should educate yourself on the uncertainty. We know that there's uncertainty and we don't see that. And I'm very disappointed. Can you go, Melody? You're doing wonderful. We're almost done. Thank you so much.
You're fine.
You go into, the impact of STR bans, the whole STR market. We see now that the, co-founder, the founder, they're selling massive amounts of Airbnb stock. We're starting to learn a lot more about the bad financing. It's not going to be as profitable. And I agree, going into recession, why would it be as profitable? But I'm looking at the actual bans, and I'm looking at how are they going to start enforcing, like, oh my gosh, Dallas, cut the legs out from underneath them. You cannot have an Airbnb in a residential zoning neighborhood. Congratulations, Dallas. I agree with that.
I do too.
So can you touch on that, Melody?
Absolutely. And New York, they always lead with this type of social behavior stuff. Think about, where the smoking ban started. It was in New York, and so. Really? Oh, yeah. Maybe there was a smaller actor, but they're the first big actor. I think they were the first because I was living there at the time. I'm pretty sure they were the first.
Did they do the gas stove thing too?
I don't know. Maybe they have. I bet they probably did, to be honest. But yeah, so all that kind of social behavior stuff, they always get in the forefront and take a stand. And then typically the rest of the country follows. And I think what's so interesting about the New York is the way that they're really making Airbnb accountable for integrating or getting information, from the city and that license. And so we'll see how it all plays out, right? There's always these shadow markets that pop up. But here's the thing, and I'm hearing it left, right, and center, is people are just stopping using Airbnb. And so because everybody who has a short-term rental knows that Airbnb couldn't give a rat's what about you. They're not going to help you, market your property. They're only going to show 300 listings when you search Austin, and they're not going to tell you there's 14,786 there. And you're going to look up in the top left-hand corner, you're going to see it says over 1,000. So every time, just Travis, try this when you're on the road. Say, like when you're in Denver, say, how many short-term rentals do you think you have here? And the answer is always 1,000, because that's what Airbnb shows up there in the top left. It says over 1,000. Well, I think, I track all this, and it's way more than 1,000 in all those cities. And so, Airbnb, they're like Uber, they're like WeWork. They pretended they were a technology company that came up with this awesome technology. It's some of the worst technology I've ever seen. They have not done any kinds of updates. Every earnings call is the same. Oh, yeah, we've got these new cool technology tools. What are they? Oh, we'll tell you later. They just never come, just like the Tesla truck never comes. It just never comes. And I think what you're seeing now is that just like WeWork, everyone knew, the music's stopping, just like Uber, they're going to get regulated. I saw this really funny tweet where it was like, I tried to get an Uber. It was going to be $120. They were going to make me wait an hour. Then they didn't show up. And then I just called for a limo. They were there on time, wonderful car, $75. So we're kind of doing this reversal of like, like Uber, like Airbnb, we're going to give you an affordable product. We're going to give you some good technology to use it. And we're going to disrupt this market. But in reality, what's happening is, they both went into, Uber went into taxi, Airbnb went into hotel. They're going to get regulated the same way that those entities have been regulated before. And so not only will it be the bans, Travis, but I think the hospitality taxes will probably kill them even more. And let's be clear, the hotels are lobbying for that. And so they're not, doing it out of your best interest. Let me put it that way. But at the end of the day, Airbnb as a company doesn't care about you. And so what's happening is people are creating their own websites, or they're going out to these really big property management companies that are kind of creating their own little, ecosystem. Yeah. So I think Airbnb, short-term rental is going to be there forever. It's been around for a long time, but Airbnb has got some serious headwinds coming its way.
Yeah. And actually, it got out oversaturated. I mean, what Airbnb, what owner of Airbnb wants to live next to their Airbnb house? I'm pretty sure, they don't. But to talk about real quick, and I want to show you, I have something up here, and I want to show it to you. But sure. I've started researching what is it called? Rent, where people are renting a house and then turning that crap into an Airbnb, Melody, and they have 10 houses that they rent under their personal name and they convert it to Airbnb. It's rental arbitrage or something? Oh yeah, arbitrage. And then that led me down another path to the Airbnb black market. I was like, what the hell's an Airbnb black market? So I was reading this and they're like, just go to Facebook, go to the marketplace and type in Airbnb. And I was like, no freaking way. They are so shameless, Melody. They were going to hold on. Those owners are going to hold on to the very end because they even put in the description, New York Airbnb. Yep. $90. Yep. Right? On Facebook. So what I've heard is because New York is regulating and watching Airbnb, the owners are just, STRs are removing themselves from Airbnb.
Exactly. Yep. But here's what's different about that, right? It's a different choice to go in and act illegally in a market versus I'm going to try to be a reputable business. And as much as we want to believe that, people, whatever, most people are not going to be like, I want to flagrantly, disobey the law. That's just not most people. And so this is going to hurt. I don't know. You're giving me a suspicious look, but I do. Okay. But I honestly think that these regulations are going to be hugely impactful. It's going to take time. And probably it's going to happen in ways that Airbnb isn't even expecting. And I think it means Airbnb is just going to become less relevant because these shadow markets will not be able to use Airbnb. And so they'll go out and that is going to cause issues because Airbnb's only model is adding listings. They have no other pathway to growth. And they've made it this long because of adding listings in other countries, not here. And they don't tell you that. They don't tell you, you can't find in their 10Q or in their earnings how many listings they added in the United States versus in other countries. This regulatory headwind is massive. Yeah.
Yeah. That's why I keep telling these people, please stop. These investors, stop buying freaking
the
Airbnb.
The mania, Travis, I have never seen anything like it. Like it, and to your point, by January, I thought I would start to see listings for Airbnb come down because we had seen it happen in Austin. And I was like, okay, we're rounding the corner. Like, but as the stock market started to go up again, the wealth effect starts taking, as home prices stopped correcting, everybody started saying, well, I've got all this equity. I've look at the stock market. I'm doing just fine. And they just kept buying. Now the rate at which they're buying decelerated significantly.
And Melanie, it's not even cash flowing and they're buying still. It's not even cash flowing.
It's true mania. It is. Every day I am just amazed, honestly. So
like this is a website, Rabu, that actually analyzes
things.
And it tells you don't turn these into look at the negative 2.9.2. The cash flow is not there anymore. Look at negative 16 cash on hand, 2% cash cap rate. Are you kidding me? You know, it doesn't work. And they're getting these. Look at this one, 21 point negative. I mean, 1,100. 1.1 million, and the revenue is $2,000 a month. Are you out of you guys out of your mind? I mean, this is crazy, Melody.
Well, and here's the thing: a lot of lenders use AirDNA, which has a partnership that nobody can really figure out with Airbnb. But AirDNA doesn't use real-time data. They do a 3-month average. So you're looking at a 3-month average for average daily rate. You're looking at a 3-month average for occupancy, and it's delayed by a month as well. And then they also don't tell people when they subscribe to that data that you can choose on your occupancy. Do you want the median occupancy? Do you want a conservative or do you want an optimistic view of occupancy, which is based on comps that aren't comps? And so I had a client that was using the data. They didn't realize they were using the optimistic view. When you look at the optimistic view versus the median, I mean, so essentially these people who are underwriting loans have been served so poorly by the technology out there. I'll give you a quick example. So Kyle, Texas, looked it up, a property that I knew was in default at another client using a certain software, I won't say. And it told me that the average daily rate was going to be $600 a day, and it would be occupied 55% of the time. Kyle, Texas is 20 miles south of Austin. It is a cow pasture town that, it's getting built up a little bit now because for affordable long-term rent. But there is no way in Hades you're going to get $600 a day, 55%. In fact, you wouldn't get that in downtown Austin. And so so the lenders have been duped as well in this non-QM DSCR space by the technology providers, which have partnerships with Airbnb. So this is just a real mess. And then everybody's like, but it's only 5% of the market that we know about now, because you and I have talked about all this private financing. So it's not.
I was about to say half the people don't know what they're talking about. It's way more than that, I feel like. But so I've used AirDNA, and I use AirDNA to show people here's how many listings are for STRs because it'll count the VRBO, and then also I'll minus out the private rooms, and I'll just look at total household units. Yeah. Dude, Holy crap, Melody, there's 3 to 5 times more.
Oh, yeah.
More
9
STRs.
to 1. Yeah. In Asheville, 9 to 1. Yeah.
Yeah, so Nashville's 9 to 1. So people are like, where's the inventory? Where's the inventory come from? Well,
That's
the
where it
inventory's
is.
there.
That's
And
right.
I like how you called it out. I've been trying to tell my viewers it's difficult to get a gauge on this, but I'm like, dude, the price is crashing is going to come from the rich. It's going to come from the investors because they capitalize the housing market and the quantitative tightening. They don't have all these free gifts and low interest rates and stupid consumers. And this is one hell of a show, Melody. Can you, and I know it's about 1:11. Let me ask you this question.
Okay.
Great stuff. Great stuff. Absolutely. Thank you for being here. I feel like you're like that missing part of like my interpretation of things, because you're that back end. Because I'm looking at like the people in their eyes, like, dude, please don't. I'm begging. I'm like, let's think about this. But let me ask you this. I was one of these people, Melody, and I understand there's buying demand on the sideline. I never didn't understand that. I've said buying demand has always been on the sideline. I didn't think this year that we would have had the bounce, and I'll call it a dead cat bounce, the type of bounce for prices in existing. Okay, we've seen the price decline continue with new construction, and that's underreported. It's much worse than it actually is.
Yeah.
Can you tell me, what do you believe propped up prices in 2023?
Con Center, Bloomberg, and new construction, right? So, and all that kind of underhandedness you're talking about. So, basically what happened, I could see there was pent-up demand last year. I could see that even if rates went down just a little bit, we were going to get demand. And I was a lone voice in that. But what the builders did is they were smart, is they took that tiny bit of demand, and like you say, they affected a 15 to sometimes 25% price reduction by the buy downs, which are going to be, and I don't care what anybody else says, these are the arms of this cycle, because they will be resetting. And 76% of builders who sold this year used a buy down. And so 3-2-1s are going to be just like your arms when they reset. We don't even know how many there are, but I'm working on it. We're going to find out. And so anyway, they bought down the rate. They paid their solar for a year. They paid to give them all new appliances. Out in Colorado, they finished the yard for them. And if you go to Denver, you'll understand why that's a big deal. And so essentially the builders came in, they took that tiny bit of demand, and they just went all out figuring out how to sell that home with all of these incentives. They took the hit in the margin. So that's, and then you had the media come out, Bloomberg and others, the sell side, saying, hey, why, you could go get one of these new homes and get all this awesome stuff. And I, was very all over that, saying, yeah, but you might be the only people in a neighborhood. Be careful about your, I just had these nightmares of a young couple like moving into one of these new build sites that I'd been at. They're the only house, and they're not actually physically secure, because a neighborhood like that of, homes that are vacant is not a secure neighborhood, period. No, and we don't have enough cops. Like, as you'll see, Travis, and I know you've seen some of it, but like some of these sites will have cops, but you don't have enough cops for all of the, and I'm sure you've heard the crazy stories of all the appliances being stolen, all that good stuff. But anyway, to answer your question, the new builds are how prices stayed up, and the shenanigans, and the fact that the only people besides that were able to transact were your investors, your top 20%, people that, weren't hurting. And so when the higher price homes are the ones transacting in the marketplace, then you're not weighting it down. And so those prices look higher, but I'm already seeing it in the cities I track, significant month over month deterioration in home prices. And so I imagine by January, we'll actually see, because, the Case-Shiller is 2 months delayed. We've only got August data right now. So I think in January, we'll start to see the decline, especially in places like Florida.
Okay. And I want to save that. I have a special question for you at the very end here about Texas versus Florida, and maybe we can both make our cases, because I think it's going to be Texas. But here's the thing that I wanted to say based on what you said, and I try to explain this You're so right about not, especially right now, you don't want to be the only one in one of these subdivisions. If the builder can't, once we go through recession, if credit event, unhinged unemployment, they can't sell, you are screwed as the borrower, as the owner. And also, Melody, not all subdivisions are the same. Like in Texas, because I have the access to MLS, like I study individual subdivisions. In some subdivisions, they're a little bit better because it's almost all sold, so they're a little bit better. But the other ones that are like new, that have the 150 spec homes, those guys are like selling at 2021 prices, destroying the recent homeowners. And also, when I went to Phoenix, it changed my shoal. And this was a surprise area. I think it was northwest. I saw entire subdivisions completed, Melody. The whole subdivision was completed. Every house was completed.
I was there.
It had 2 or 3 owners, and there's 200 houses empty. And I'm just thinking to myself, y'all are brave.
I was like, there's going to be a lot of surprised investors with surprise, and you know they don't have the infrastructure either. I mean, it's there's one road in there, one road. So yeah, that's already backed up. I mean, it's surprise is one of the most. It was a very overwhelming experience. Yeah, you can't actually describe it to people, and then when you leave. You actually don't even believe what you saw.
I remember because I started with South Phoenix, so I did like the video there, and then when I was driving down the freeway to Surprise, dude, at one point I was like looking around on the freeway. I'm like, what the hell? I'm like, there's a freaking building there, like everywhere I looked, there was thousands of homes being built, and there's like no jobs. So I asked the sales agents, I'm like, you worried? Are you worried? Because you got 500 houses right there and you only sold one. Are you a little worried? And she's like, well, not really. And I was like, well, why the hell are you guys building this house in the middle of nowhere? And they told me, Melody, they said because of the freaking trash chip plant that they're trying to make out there. So they did all of this prior.
The Taiwanese are like, we're going to have to get the workers from Taiwan because you don't have enough skilled workers here. Exactly. Yeah, that plant.
Yeah, like, oh, this is great. Where are you going to get the workers? We are not capable in the U.S.
Right.
Anyway.
So the idea that this is going to bring all these jobs, right, to warrant these houses. And this is why I say, and I'm almost one of the only people that says it, is that commercial and residential are inextricably linked. Because what people don't realize is that all this housing was being put up to support commercial projects that have been paused. They're not happening. All these Amazon but warehouses like in Round Rock. That's why they built all that, because they were going to build a big Amazon facility that's no more. And so, so as this commercial kind of goes away, so does a lot of the need for the residential. Like Austin is a prime example. That's why they were building 40 miles north, south, west, and east. But now there's plenty of housing for everybody much closer. It's nuts. And so your question is, Texas over Florida, you go,
Okay. So here's the debate. Now, first of all, I understand like the last housing market, great financial crisis, Texas made it out pretty good, comparatively pretty good. But I think it's possible. So the question is what is from a price standpoint, what is going to decline more as a state, Texas or Florida? I'm going to side with Texas, and I'll tell you why. The number one reason is the new construction. I think that the new construction, we have the inventory, the price cuts, the incentives is eventually, and it's already spreading onto existing homes. The migration out of Austin, we've had 4 metro areas, which is really crazy. Like at one point, the top 5, if you look at the 4-week rolling average of median sales price, the top 5 metro areas price decline, 3 of them were in Texas. So I'm like, I told you guys, it's new construction. I told you follow the new construction. So so I think that Texas overall is going to lead Florida. My thing with Florida is like the freaking unaffordability is bad out there, man. So I'm going to say number one reason is because we got the asset bubble. We have the migration slowing in Austin. We just have so much. We're the number one state in new construction, new build. I'm going to have to go Texas because of the new construction. I know it's in Florida as well, but that's why I have to go with Texas over Florida. What do you have to say?
Well, so Travis, in February, I was on record as saying that I thought Texas was going to be,
Really?
was going to take the cake. Oh, absolutely. I was on record. I can go back and find the tweets. Then I went to Florida the first time in February. And it was shocking around Lakeland, like some of these areas I could worse in many ways than Austin because they were just getting started in Florida. So I went back down to Florida in July. I spent 2 months in Miami area, and then just driving all over Florida. And at the same time, I read Bubble in the Sun and Swamp Peddlers, which are, if you invest in Florida, I highly recommend these 2 books. I could not believe these. I helped manage the default crisis, and I spent most of my time down in Florida in 2012 and 2013. So I know, but I didn't realize, that this cycle has played many times before. And then, looking around Fort Lauderdale, looking around those areas, Port St. Lucie, just Marathon, it was everywhere. And it's like every piece of viable land is for sale. If it's not for sale, it's being developed. And in swamplands like Lakewood Ranch and the people, I'm going to get some hate on this, but you can't even get decent cell service for GPS. Like it's in the middle of nowhere. And they've built this entire town as if all of New York is moving down there with a nice little city center. I heard stories about people getting in limos to go to the strip, the outdoor mall with the tequila bar. That's just not sustainable in our go forward economy. But anyway, so I was with you until I spent a decent chunk down in Florida. And I was like, I cannot even believe this is possible because I would have thought all these people would have been burned. But what happens is that a new set of investors come in every time. It's a new narrative. Back during the Great Depression, before the run up was all about, illegal liquor. This time it was about crypto in Miami. I mean, there's always something. And the speculators and investors, because the story about Florida is, the beaches, everybody's going to take a vacation, blah, blah, blah. And then the second home ownership there, Travis, and the international ownership. These are the things like when I was staying in a condo, and they call them the ghost condos, because you would look out around you and you would see a 50-story condo building and there'd be one light on. And of course, I was there in the summer, so that's not the season. But regardless, all these buildings were like that. And you talk to people there, they're never fully occupied. A lot of it's internet ownership for money laundering purposes. That's a big part of it. And so I think that the shadow inventory there is so astronomical. And then on top of that, the insurance issue, 4 times the national average, that was before this year's increases, and the property taxes, and this tax called the CDD, which is on new development that nobody knows about. I think ultimately when we're all at the end of this looking back, Florida will experience the worst of it. Texas will be competing the whole way through, and they may take first place. It's going to be a real race between the two of them. And I think they're both going to be worse off than California, believe it or not. So,
well, I'll see you at the finish line.
Exactly. I'll see you there.
So,
and I'd rather neither of them have to go through this, but
I know. I mean, we didn't do this, Melody. I mean, we're sitting here warning people. We're not sitting here making the problem worse. So it's not our fault. It's not like we want people to be hurt. We're talking about it because we don't want people to get hurt.
Right.
People get that confused, like, oh, why are you so negative? It's like, well, what did you, because I opened my eyes and I see what's in front of me. And when you're warning someone of a hurricane or a tornado that's coming, you don't passively go in the corner and whisper it to them. You speak up, have courage, go against your peers if necessary, and you sit in the chair like we're doing. And you say, here's my perspective. Here's why, and I think you're doing a great service to people, Melody. I know that I've really enjoyed following you. I know we've been talking for a while. I'll go ahead and end this, but before I do, I would like to give you the last word.
Well, I think you kind of summed it up, Travis. Like, we're not here. People accuse me all the time of, oh, you're just trying to be a doomer and get, followers. You and I talked before the show. I'm overwhelmed. I don't actually want any more followers right now. We're here because we've been burned. We both have personal stories, of getting burned by what's happening right now, unaffordability, like a crash in prices, things like that. And to me, I'm here because I really want to save young families from making one of the worst decisions of their lives that's going to impact their marriage and their children. And also, if you have an investment that goes sideways, which will also have the same impact. So, we're trying, I guess, what I think both of us are trying to do is give people as much information as possible to make an informed decision. You may still decide to buy or invest, but at least you'll have all the facts going in and you can make better choices and you can negotiate better as well, But I think at the end of the day, guys, the mainstream media does not have your best interest at heart. They have the best interest of the top 20% for the most part. And even them, they're not being honest with so that they could make informed choices. And so, just question everything, question the data, question the narrative, and question the people that are going to get paid by the decision you make. Like that's really my last words, that just don't believe everything you hear and go look for yourself as well. So there you go.
I couldn't have said it better myself. Melody, from the bottom of my heart, thank you so much. You've filled in a couple of the missing blanks here. You guys, don't forget to go over to Melody Wright's channel on YouTube. Watch her stuff, subscribe, show this woman some love, support her, give her some intel, email her, just share your thoughts, share your opinions. And other than that, guys, if you're out there investing in real estate, we wish you luck and we hope
yes,
you win.